right now, tankers are literally burning in the Middle East.
Yeah, quite literally on fire.
Right. And two of the most vital global shipping straits on the planet are under direct threat or active blockade. We've seen a highly anticipated ceasefire completely collapse in just a matter of days, reverting instantly back to rocket fire.
It's just a remarkably fragile situation.
Exactly.
Yeah.
Geopolitically speaking, the world is flashing bright, blinding red. Yet, if you look at your investment portfolio this morning or, turn on the financial news, you're seeing a completely different planet.
Oh, totally. The disconnect is wild.
Tech and ship stocks are bouncing back. The NASDAQ is up 1.5%. Bitcoin is up 1.5%. So the core question we are unpacking today is, how on earth can massive global instability and supreme financial market exuberance coexist in the exact same moment?
It honestly feels like a hallucination. I mean, you have physical supply chains on fire and financial markets acting as if we are entering a golden age of unbridled growth.
It's completely bizarre. So, welcome to today's deep dive. We are going to untangle this massive paradox using a dense, rapid-fire stack of geopolitical and financial analysis we've been provided.
And there's a lot to get through.
Oh, definitely. Our mission today is to trace the invisible wiring connecting burning oil infrastructure in the Gulf, a truly bizarre divergence in how Wall Street tracks inflation, a terrifying wave of margin calls wiping out retail investors in South Korea, and ultimately what all of this means for your wallet.
Which is the part everyone actually cares about.
Right, exactly. But before we get into the weeds, I want to note to you, the listener, that our source stack today dives into some heavily radioactive political territory.
Very radioactive.
Yeah. It covers rumored backroom deals involving Donald Trump and Xi Jinping, as well as the ongoing severe conflict between Israel, Iran, and the U.S. To be absolutely clear here, we aren't taking any political stance or passing moral judgment on any of these figures or nations.
No, not at all. That's not what we do here.
Right. We're simply putting on our analytical hats to untangle the economic mechanics and market strategies exactly as the sources present them. We are just the guides mapping out the terrain for you.
And what's fascinating here is the terrain itself. Because when you strip away the political rhetoric and look strictly at the underlying ledgers, the major global economies might actually be fundamentally weaker than the headline numbers suggest.
Wait, weaker, even with the market rallying?
Yeah. That hidden economic fragility might actually be the very thing absorbing the shock of all this geopolitical chaos.
Okay, let's test that theory by starting with the most immediate crisis our sources outline, the geopolitical powder keg in the Middle East and the threat to the twin choke points of global shipping. The transcript details that this heavily negotiated ceasefire between the U.S., Israel, and Iran practically evaporated overnight.
Which wasn't entirely unexpected, honestly. The sources highlight a really complex multi-actor gridlock. Well, they point to claims that Israel fundamentally does not see a strategic advantage in a ceasefire right now, which inherently blocks any path to permanent peace.
Right. You can't force a truce if one side thinks pausing is dangerous for them.
Exactly. You simply cannot maintain a truce if a primary combatant views a pause as detrimental to their long-term security. And on the flip side, the sources report Iran is allegedly putting staggering demands on the table.
Yeah, I read that part. Staggering is an understatement.
We're talking reparations somewhere in the neighborhood of $300 billion, along with other conditions the U.S. and its allies are just never going to accept.
So the diplomatic gap is essentially a canyon at this point.
A complete canyon.
And because diplomacy is failing, the rhetoric is escalating to actual infrastructure targets. The sources note Donald Trump is reportedly threatening to bomb Iranian nuclear facilities, but, and this is the part that got me more surprisingly, Iranian desalination plants.
Yeah, that's a massive escalation.
I understand the strategic logic behind targeting nuclear sites, but why desalination? That seems like a really strange military priority.
Well, water is the ultimate leverage in the Middle East. Targeting a desalination plant crosses a massive, almost existential infrastructure red line.
Because they literally don't have fresh water otherwise.
Right. These nations rely on the ability to remove salt from seawater just to keep their populations alive and their agriculture functioning. Natural aquifers are either depleted or just totally insufficient.
So it's not just breaking a machine.
No, not at all. If you strike a nation's desalination capacity, you aren't merely neutralizing a military asset. You are weaponizing thirst. You are threatening the immediate survival of millions of civilians.
Wow, that is the ultimate scorched earth tactic.
And the sources point out the immediate domino effect of crossing that red line, too.
Retaliation, I assume.
Exactly. If Iranian water infrastructure is hit, the obvious retaliation is for Iran to target the desalination plants of U.S. allies in the region,
Like who?
specifically the United Arab Emirates. You suddenly escalate from a localized exchange of rockets to a humanitarian and infrastructure collapse spanning the entire Persian Gulf.
Okay, so while this brinkmanship over water and nuclear sites is happening, the actual physical transit of the world's energy supply is being choked off right now.
Right, the shipping lanes.
Yeah. The transcript focuses heavily on the dual threat to the Strait of Hormuz and the Bab el-Mandab Strait. And I think we need to establish the geography here because the market reaction is defying basic logic.
It really is. It makes no sense on the surface.
Let's unpack this using an analogy. Think of global oil transit like a massive international highway system. The Strait of Hormuz is the multi-lane expressway, right? It carries about 20% of global oil throughput, mostly sending it straight to the massive economies of Asia.
A vital artery. Without question, everyone watches Hormuz.
But then you have Bab el-Mandab, which is currently blockaded by the Houthis. The source mentions the strait handles about 4.2 million barrels per day.
Which is a huge chunk of European energy.
Right. So in our analogy, Bab el-Mandab is the crucial bypass road that routes all the essential deliveries up through the Red Sea into the Suez Canal and directly into Europe.
Spot on.
So if someone throws up concrete barricades and blocks both the expressway to Asia and the bypass to Europe simultaneously, shouldn't the entire global traffic grid just lock up?
You would think so, yeah?
We should be seeing oil prices going completely parabolic. Yet the sources explicitly note that Brent crude was hovering around $91.50, and WTI West Texas Intermediate was sitting at just $84.
Yeah, barely a blip.
If the two main energy highways of the world are shut down, why isn't oil at $150 a barrel?
To solve that puzzle, we actually have to look at the economic health of the destinations on those highways. Let's look at Europe and the blockade at Bab el-Mandab.
Okay, the bypass road.
Right. If that road is closed, or insurers just deem it too dangerous to navigate, shipping conglomerates are forced to reroute their massive tankers all the way down and around the southern tip of Africa, the Cape of Good Hope.
Which adds immense friction. You're talking, what, weeks of extra travel time?
Weeks of travel, exactly. Which means millions of dollars in extra bunker fuel burned, vastly higher insurance premiums, and extended capital lockup for the buyers.
So everything gets way more expensive.
You are permanently raising the baseline cost of every single imported good in Europe. But here is a critical variable. The sources emphasize the European economy is already incredibly weak. It's struggling with stagnant growth.
Wait, hold on. If the route is blocked and costs are up, oil should be $150. The only way it stays at $90 is if the buyers simply stopped buying. Is Europe's economy so battered right now that demand destruction is actually masking the supply shock?
You've hit on a massive piece of the puzzle right there. It's not that the oil is flowing smoothly. It's that Europe is too economically exhausted to bid up the price.
Oh, wow.
Yeah, when industrial activity slows down, a continent simply requires less energy. However, even with Europe's demand destruction, the sheer volume of oil threatened in the Gulf should have spiked prices much higher globally.
So there's another missing piece.
There is. The real reason we aren't seeing absolute catastrophe at the gas pump lies in a completely different hemisphere. It comes down to engineered halts and emergency levers being pulled to their absolute physical limits.
Which tees up a profound anomaly in the oil market detailed in the text. The source material points a massive finger directly at China, stating that Chinese oil imports, quote, fell off a cliff.
They absolutely plummeted.
Now, based on what we just discussed with Europe, my first instinct would be to assume China's economy is just organically slowing down too.
A logical assumption, but wrong in this case.
Right, because the sources highlight a Reuters compilation suggesting this wasn't organic weakness at all. It was an engineered, intentional halt to oil imports.
It was entirely deliberate.
How does a country with the industrial footprint of China just decide to stop importing oil during a global crisis without its own economy seizing up?
They utilized a highly coordinated, centrally commanded logistical pivot. Early in the conflict, the Chinese government actively curbed their own fuel exports.
So they kept everything they refined inside their own borders.
Exactly, ensuring whatever refined products they had stayed domestic. But the more fascinating mechanism the sources point to is transit substitution.
Transit substitution?
Yeah. In major metropolitan areas like Beijing and Shanghai, the population heavily utilized vast fleets of electric vehicles. specifically electric taxis, rather than personal combustion engine cars.
Let me make sure I'm connecting this correctly. Are you saying that a centrally mandated shift to electric taxis in Chinese megacities absorbed enough fuel demand that it acted as a geopolitical shock absorber for the entire global market?
The math presented in the sources suggests exactly that.
That is insane.
It is. By orchestrating this halt in imports, likely to shield their own domestic economy from the initial price shocks of the Middle East conflict, China artificially depressed global oil demand.
Which kept the prices down for everyone else.
The supreme irony here is that China's self-preservation tactic inadvertently saved the United States from facing catastrophic oil and gas prices right before the midterms.
Man. Had China continued purchasing oil at their baseline rate while the straits were under threat, the global price per barrel would have inevitably skyrocketed.
Without a doubt.
That is a staggering butterfly effect. A transit policy in Shanghai basically keeps gas prices stable in Ohio.
It's all connected.
But China wasn't the only one pulling levers. The source spends a lot of time on the U.S. Strategic Petroleum Reserve, the SPR, noting it has been depleted to its lowest level since 1983.
Yeah, 1983.
We are talking about burning through over 40 years of emergency buffer.
And we need to understand the physical reality of the SPR because it dictates why this strategy has a hard expiration date.
Okay, break that down for me.
The SPR isn't just, a spreadsheet tracking digital barrels of oil. It is a physical engineering marvel consisting of massive, hollowed-out salt caverns deep underground in Louisiana and Texas.
That's crazy. I always pictured it as a series of giant, pristine metal tanks out in a field somewhere.
Most people do, but it's geological. They literally pump fresh water into salt formations to dissolve the salt and create these massive voids, then pump the crude oil in.
Okay, so how do they get it out?
Because oil floats on water, to get the oil out, they pump water down into the bottom of the cavern, which pushes the oil up to the surface. But the sources emphasize a crucial limitation here. You cannot drain these caverns to zero.
Why not? I mean, if I have a gas tank in my car, I can run it until the needle hits E.
Right, but a car's gas tank is a static metal container. An underground salt cavern relies on specific pressure dynamics to maintain its structural integrity.
Oh, so the shape of the cave actually changes.
Exactly. As you replace more and more oil with water, the pressure dynamics change. Furthermore, the remaining oil at the very bottom often mixes with brine and sediment.
So it turns into, like, sludge?
Exactly. It becomes a thick sludge. You eventually hit a technical floor where the remaining crude is too mechanically complex, too slow, or too expensive to efficiently extract.
And we are hitting that floor.
The sources are warning that we are rapidly bumping up against that physical extraction limit right now. The U.S. has essentially squeezed the emergency sponge dry.
So we have China engineering a temporary demand vacuum, and the U.S. draining its emergency geological piggy bank to the absolute floor.
Yeah, both pulling their biggest levers at once.
But the sources venture into some geopolitical speculation that suggests these two actions might not have been a coincidence at all. They detail a rumor regarding a potential backroom deal between Donald Trump and Xi Jinping.
Yeah, the analysis zeroes in on a very specific timeline there.
What's the timeline?
It notes that immediately following a meeting between Trump and Xi, Trump's rhetoric regarding Taiwan completely shifted, and mere days later, the U.S. froze a scheduled arms shipment to Taiwan.
Okay, if I'm reading between the lines of this source material, the implication is massive. Is the transcript suggesting that the U.S. traded long-term geopolitical leverage over Taiwan in exchange for China artificially suppressing its oil imports to keep global energy markets stable?
That is the speculation raised by the analysts in the text, yes.
That's wild.
If such a quid pro quo was struck, it represents an invisible macroeconomic lever of immense power. It's the kind of geopolitical horse trading that operates entirely in the shadow.
Because nobody puts out a press release for that.
Exactly. The public won't see the terms of the deal. They only see the mysterious ripples it causes,
Yeah.
A frozen arms shipment here, an inexplicable plunge in Chinese oil demand there.
But even with these massive coordinated efforts to suppress the price, the physical reality of the conflict just keeps interrupting. The source had this incredible detail about vessel traffic in the Strait of Hormuz.
Oh, the ceasefire sprint.
Yeah. During that brief ceasefire we mentioned at the very beginning, vessel traffic absolutely spiked. They tracked 77 ships crossing the strait in a single month.
And the analyst in the source explicitly flags that as a deceptive metric. It wasn't a return to a healthy, normalized supply chain at all. It was a temporary glut. Picture a massive backlog of tankers, anchoring in safer waters, bleeding money daily, just waiting for a window. The moment the ceasefire was announced, they all sprinted through the strait at once.
Like holding your breath and running across a battlefield when the shooting stops for just a minute.
Precisely the right imagery. And the moment the ceasefire collapsed and the rockets resumed, the traffic halted again. You just cannot sustain a global supply chain on a hold-your-breath-and-sprint methodology.
Which brings us to the inevitable mathematical conclusion. If the U.S. SPR is tapped out to 1983 levels and global emergency reserves are at historic lows, the world is operating with zero buffer.
Zero. We are flying without a net.
Even if the Middle East de-escalates tomorrow, every nation on Earth is going to have to eventually buy millions of barrels of oil just to refill their emergency tanks.
Exactly. When that synchronized global restocking phase begins, it'll introduce a tidal wave of buying pressure onto the market over the next year.
And when massive buying pressure meets constrained supply, prices go up, which means that lagging inflation we thought we beat is going to come roaring back.
Oh, it's virtually guaranteed.
The transcript points out that the official CPI, the Consumer Price Index, recently dropped from 4.2% down to 3.5%. So on paper, it looks like a victory.
It looks like a victory until you understand the mechanics of the metric itself.
Right, because it's a mirage.
Basically, yeah. The drop to 3.5% is primarily the shadow of those earlier oil dynamics we just discussed, China's import halt and the SPR drain. The sources issue a severe warning about relying on the CPI because it is inherently backward-looking.
It's lagging.
It operates on a 30-day lag. You're looking at the economic weather from a month ago. It is completely blind to the real-time, instantaneous shock of a resumed war or a blockaded strait today.
So to figure out what inflation is actually going to do tomorrow, we can't look at the CPI. We have to look at the bond market.
That's where the smart money's looking.
And this is where the source material highlights a terrifying disconnect. It points to two specific financial instruments that track inflation expectations. First, the 10-year break-even inflation rate.
Right. The 10-year break-even is a crucial metric. It's derived by comparing the yield of standard nominal Treasury bonds with the yield of Treasury inflation-protected securities.
Okay, so what does that difference actually tell us?
The difference between those two yields tells you exactly what the bond market, which manages trillions of dollars, mind you, believes average inflation will be over the next decade.
And what do they believe right now?
Well, the sources note that this 10-year break-even rate has been steadily climbing since mid-June. The smart money is actively betting that inflation is accelerating.
But then the source points out a complete contradiction. There is an ETF, the TIP ETF, which holds those Treasury inflation-protected securities. And according to the data, while the 10-year break-even is climbing, the TIP ETF is actually going down.
Yeah, which makes no sense on a surface level.
I need you to explain how that is mathematically possible. If they are both tracking inflation expectations, shouldn't they move together?
They absolutely should. If we connect this to the bigger picture, this divergence is a glaring anomaly. A divergence of this magnitude between the break-even rate and the TIP ETF just shouldn't happen.
Why would they decouple like that? Is the market just broken?
When institutional instruments decouple, it usually points to one of two realities. The first is that it's a temporary mechanical glitch driven by liquidity issues.
Like a bug in the system.
Kind of.
Yeah.
It creates a massive arbitrage opportunity for hedge funds to buy one, short the other, and wait for reality to force them back into alignment.
And the second reality.
The second is that the global market is deeply, fundamentally schizophrenic about the state of the economy.
Schizophrenic how?
Well, the climbing break-even suggests terror over supply shock inflation from the Middle East. But the falling TIP ETF suggests investors are actually liquidating inflation protection because they secretly believe the global economy is so weak and demand is going to collapse so hard that inflation won't be able to survive the upcoming recession.
Okay, let me pull this out of the theoretical bond market and bring it down to the listener's local supermarket. I don't buy ETFs. I buy groceries.
Exactly. People feel this at the store.
The source warns that grains are already up. Walk me through the exact mechanical chain reaction from a blockaded strait in the Red Sea to a 20% markup on a box of cereal.
The chain reaction is brutally direct. Agriculture is effectively a derivative of energy.
Because of the fuel to farm it.
Yes. You need staggering amounts of diesel to run the tractors that plant the wheat, the harvesters that collect it, and the freight trains that transport it. Plus, you need natural gas to synthesize the fertilizer required to grow it in the first place. So when the Bab al-Mandab Strait is threatened, and ships take weeks longer to navigate around Africa, the cost of the bunker fuel for that journey skyrockets.
And the farmers have to eat that cost.
Exactly, and that increased transportation cost is instantly absorbed into the wholesale price of the grain. By the time that wheat is milled, boxed as cereal, and trucked to your local store, every single compounded energy shock along that supply chain is passed directly to the consumer.
So that 3.5% CPI number is going to catch up to the reality of the cereal aisle very soon.
Unfortunately, yes.
And that puts the Federal Reserve on an impossible tightrope. The sources note that bond markets are pricing in a near certainty of 2 to 3 interest rate hikes by the end of the year, though they expect no change at the immediate upcoming FOMC meeting on July 29th.
Right, the Fed needs time to digest the chaos, hence the July pause. But those future hikes are the real threat.
But if the Fed is forced to hike rates 2 or 3 more times into a global economy that is already weak just to fight supply shock inflation caused by a war they literally can't control, aren't they basically guaranteeing a recession?
It is the textbook definition of a central bank policy error.
How so?
Normally, if an economy is slowing down, a central bank lowers interest rates to make borrowing cheaper and spur growth. But if they are forced to raise rates to fight inflation driven by external supply shocks, they make capital incredibly expensive at the exact moment businesses need it most.
So they just crush whatever growth is left.
They risk suffocating whatever economic growth remains, yes.
They are prescribing chemotherapy for a broken arm. The treatment is going to kill the patient.
That's a grim way to put it, but accurate.
Which brings us to the most baffling part of this entire deep dive. If inflation is rebounding and the Fed is going to choke the economy with rate hikes, the stock market should be terrified. Yet, the AI sector seems to have completely repealed the law of financial gravity.
The AI narrative has become an event horizon. It is pulling capital inward with absolute disregard for the deteriorating macroeconomic conditions.
Because everyone thinks AI is going to change everything tomorrow.
Yeah. As the sources noted, chip stocks were leading a massive recovery, pushing the Nasdaq up 1.5% on the very same day Middle Eastern shipping lanes were being blockaded.
But the transcript spends a significant amount of time outlining how severe architectural cracks are showing in this AI facade. It points out that if you look at the stock charts for major legacy chip makers, specifically Intel and Qualcomm, the visual geometry is terrifyingly familiar.
Very familiar. The analyst in the text directly compares the charts of Intel and Qualcomm today to the charts of tech companies during the year 2000 dot-com crash.
With the speculative mania geometry.
Exactly. The visual pattern is unmistakable. It's a parabolic vertical trajectory upwards, driven by sheer FOMO, fear of missing out, followed by an equally violent straight-line trajectory downwards as the math catches up with the hype.
Just a total boom and bust curve.
Yeah. And the sources note that Qualcomm is already leading this charge downward.
But the most shocking data point in this entire text, the one that actually made me stop reading and do the math myself, is what is happening right now in South Korea.
Oh, the margin call wave.
Yes. The sources describe an absolute bloodbath in the Korean retail investing market, stating that 1.2 million accounts faced margin calls in a single week.
To contextualize that scale, the source emphasizes that 1.2 million accounts represents 10% of all investment accounts in South Korea.
That is just incomprehensible.
It's roughly 3% of the entire adult population of the country, wiped out in 5 trading days.
1.2 million accounts margin called in a week is not a market correction, it's a financial tsunami.
We need to dig into the mechanics of this because I don't think people realize how fast leverage can destroy a portfolio. Walk me through the math of how a retail trader gets margin called that quickly.
Let's construct a hypothetical retail trader in Seoul. Buying on margin means this trader deposits, say, $10,000 of their own cash into a brokerage account, but the broker lends them another $20,000. So they have $30,000 to play with.
Right. They now have $30,000 of buying power. Leverage amplifies your gains, obviously, but it brutally, exponentially amplifies your losses. Furthermore, the sources specify that these Korean retail traders were heavily buying leveraged ETF products.
Okay, for the listener, those are ETFs that use derivatives and swaps to multiply the daily return of an underlying index, usually by 2 or 3 times, right?
Correct. So if the underlying index goes up 2%, the 3x leveraged ETF goes up 6%.
Sounds great on a good day.
But here is the trap. They reset daily. This creates something called volatility decay. If the market goes sideways, the math of the daily reset actually eats away at the value of the ETF.
Just from bouncing around.
Yeah. Now combine those two things, borrowing money on margin, to buy an asset that is mathematically designed to multiply losses and decay over time.
It's financial nitroglycerin, and the source states the trigger for this specific explosion was a stock called SK Hynix.
Right, SK Hynix.
So SK Hynix is a massive South Korean memory chip maker fundamentally tied to the AI hardware build-out. The text notes that earlier in the year, SK Hynix and Samsung were the engines pushing the Korean Kospi Index to be the #1 performing stock index in the entire world.
And the retail traders saw that momentum and piled in using leverage, expecting the AI chip rally to be a permanent paradigm shift.
It's the .com FOMO all over again.
Exactly. But then SK Hynix dropped 30%.
Okay, if a foundational stock drops 30% and you are holding a 3x leveraged ETF on margin, the math gets incredibly dark very fast.
Total systemic collapse. The sources state that those leveraged ETF products collapsed by 70%, and in some cases even more.
70%.
Yeah. When an account loses 70% of its total value, but 2/3 of that money was borrowed from the broker's algorithm automatically issues a margin call.
Which means they want their money back.
Instantly. They demand the trader deposit thousands of dollars in cash immediately to cover the borrowed funds.
And retail traders rarely have that kind of liquid cash just sitting around.
Exactly. When the trader can't meet the call, the broker's risk management software takes over. It automatically liquidates the entire account to protect the broker's capital.
It just sells everything.
It sells all the trader's assets at market price, regardless of how low that price is.
And when 1.2 million accounts are being algorithmically auto-liquidated at the exact same moment, it creates a terrifying feedback loop, doesn't it?
Oh, absolutely.
Because the forced selling drives the price of the stocks down further, which triggers the margin parameters for the next batch of accounts, which triggers more automated selling.
It is a cascade of pure mechanical market panic. And the crucial takeaway from the sources is that they view this South Korean bloodbath not as an isolated, localized event, but as a potential leading indicator for global chip stocks.
A warning sign.
A massive one. It exposes the huge amount of fragile, hidden leverage that is actively propping up the global AI trade.
And it's not just the financial leverage that's fragile here, it's the fundamental business architecture of the AI build-out itself. The source details a deep structural problem with AI capital expenditure, or CapEx.
Yeah, we have to contrast AI with a traditional software business model to understand this.
Okay, how did traditional software work?
Well, the narrative for the last 20 years has been that tech companies spend heavily upfront on research and development, but then achieve almost infinite economies of scale.
Write it once, sell it a million times.
Exactly. You spend $1 billion to write the code for a software suite, but then it costs you practically $0 to copy that code and distribute it to 1 billion users. The return on investment, the ROI, becomes astronomical.
But the source explains that AI completely breaks that economic model.
It breaks it because AI does not quickly achieve those zero marginal cost economies of scale. Think about the difference between training a model and running a model. Training costs billions. But the real issue is inference the cost every time a user queries the model. Every single time someone asks a large language model to write an email or generate an image, it requires a massive amount of immediate physical compute processing in a data center.
You are constantly burning physical energy to keep the digital engine running.
The compute costs never go to zero. AI requires endless, continuous capital expenditure in the form of specialized chips, massive server farms, and staggering amounts of electricity just to maintain daily operations.
So they have to keep spending billions just to keep the lights on.
Right. The source argues that this dynamic drastically diminishes the ROI on every new dollar spent compared to older tech paradigms. The market is slowly waking up to the realization that the revenue generated by selling AI subscriptions might not ever justify the astronomical physical infrastructure costs required to run them.
Which leads to the most apocalyptic predictions in the source material. The transcript heavily features the views of investor George Noble. And Noble claims that this current AI bubble is 17 times worse than the 2000 crash.
Which is a very aggressive number. He is basing that on how wildly overstretched the valuation multiples are for these massive tech companies compared to their projected cash flows.
And Noble isn't pulling any punches. According to the source, he predicts Tesla will fall all the way down to double digits. He claims SpaceX's fair value is a mere $30 a share,
which is a fraction of its current implied value.
And most shockingly, he predicts that both OpenAI and Oracle will ultimately go bankrupt. Now, let me push back on that because that sounds like the hyperbole of a permabear who just happened to get a few short-term calls right. Are we really looking at OpenAI going bankrupt, or is he just trying to grab headlines?
It's a highly provocative claim, for sure, and it should be viewed through the lens of extreme market contrarianism. However, it forces us to evaluate the risk spectrum.
What do you mean?
We have to deduce if the current pullback we are seeing in legacy chip stocks like Intel and Qualcomm is simply a healthy, natural re-rating of valuations as companies slightly slow down their server purchases. Is it just a standard market speed bump?
Or is it the canary in the coal mine?
That is the ultimate question. Is it the first stress fracture in a systemic wipeout of the entire AI trade?
What do the sources conclude?
The source leans toward the idea that we are currently experiencing a repricing for a capex slowdown, manifesting first in the chip makers. But the scale of leverage exposed in South Korea suggests the underlying foundations are far more brittle than the headline stability of the Nasdaq implies.
So, if tech is teetering on a 2000-style cliff and inflation is rising due to Middle East supply shocks, traditional investing logic dictates you should run for the hills and put all your money in the ultimate millennia-old safe haven gold.
That's what people have done for centuries.
But our deep dive uncovers what the sources called the gold myth. Because according to the data provided, gold is behaving completely contrary to popular belief right now.
Yeah, the data is systematically dismantling a lot of deeply held assumptions within the precious metals community.
Walk me through the numbers.
Let's first establish the technical levels the sources outline. Gold has formed a base around $4,000 an ounce.
But the analysts are clearly nervous about it holding that line. The source mentions they are actively watching a crucial support floor of $3,500 to $3,600. And Bank of America recently lowered their end-of-year target for gold by 14%, down to $4,300.
And the justification for this downward revision is what makes the analysis so compelling. The most pervasive, unquestioned narrative in finance is that gold is an inflation hedge.
Right. When the cost of living goes up, gold is supposed to go up to protect your purchasing power.
But the source data flatly proves this false in the current macroeconomic environment. It points out that as inflation expectations actually rose at the start of the Iran war, the price of gold went down.
That is wild. Walk me through the mechanics of that. Why would gold fail at its primary historical job?
This raises an important question, and it comes back to the causal chain we discussed earlier regarding the Federal Reserve.
Okay, remind me.
We have supply shock inflation caused by the threatened shipping straits. Supply shock inflation immediately drives up the bond market's expectation that the Fed will have to raise interest rates to fight it.
Okay, higher inflation equals higher interest rates. I follow that.
Now, look at the fundamental nature of gold as an asset. Gold is a physical lump of shiny metal. It is a non-yielding asset.
Meaning it doesn't pay you.
Right. It does not pay you a quarterly dividend.
Mm-hmm.
It does not pay you interest. It just sits in a vault, and you actually have to pay someone to guard it.
Right, there's a carrying cost.
When the Fed keeps interest rates very low, near zero, holding that lump of metal is fine because the opportunity cost is zero. You aren't missing out on yield anywhere else.
It's just cash in the bank pays nothing anyway.
Exactly. But when the Fed drives interest rates high to fight inflation, the entire calculus changes. Suddenly, holding U.S. Treasury bonds becomes incredibly attractive.
Ah, I see where this is going.
Why hold a non-yielding lump of metal that fluctuates in price when you can hold a virtually risk-free government bond that guarantees you a 5% or 6% yield every single year?
So the opportunity cost of holding gold simply becomes too high for institutional investors to justify.
Precisely. Higher real interest rates categorically crush gold. And because the market expects the Fed to keep rates high to fight the supply shock inflation, institutional capital flees gold and flocks to high-yield treasuries.
Let me play devil's advocate for the listener here. If I'm a retail investor holding gold in my physical safe because I expect it to protect me from World War III breaking out in the Middle East and runaway global inflation destroying the dollar, you're telling me I'm operating on a complete fallacy.
According to the data, yes.
That the Federal Reserve's interest rate policy is the only variable that actually dictates gold's value.
The historical data presented in the source material aggressively supports that conclusion. The sources thoroughly debunk the idea that gold is driven by geopolitical news or panic.
Wait, really? It doesn't spike on war news.
They point out that central banks, who are the ultimate largest buyers of gold on the planet, do not make purchasing decisions based on CNN headlines. They buy based strictly on price sensitivity.
The source compares central banks to hedge funds buying the dip.
Exactly. They are managing a massive sovereign balance sheet, not reacting to political panic. They buy when gold is relatively cheap compared to other assets, and they step away when it gets expensive.
But what about the geopolitical premium? Surely gold spikes when bullets start flying.
It does, but the sources emphasize that these geopolitical risk premiums are incredibly short-lived and eventually overpowered by macroeconomic gravity.
Give me an example from the source.
The transcript provides a perfect historical example. When Russia invaded Ukraine in February 2022, gold immediately spiked by about $200 an ounce. But it very quickly reversed and fell back down as soon as the Federal Reserve began its aggressive cycle of raising interest rates.
Oh, wow. So the rate hikes just crushed the war panic rally.
Exactly. The macroeconomic force of high interest rates entirely obliterated the geopolitical panic of a land war in Europe.
The source also takes aim at the myth of the post-9/11 gold rally. I think a lot of people assume the massive decade-long gold bull run in the 2000s was driven by the fear surrounding the invasion of Iraq and the global war on terror.
The sources argue that is a complete misattribution of cause and effect.
So what really caused it?
That historic bull run was not fundamentally driven by geopolitical conflict. It was driven by a decade of structurally low interest rates instituted by the Fed, which made non-yielding assets like gold incredibly attractive.
The source even details a fascinating timeline of early year panics to prove how disconnected gold is from actual kinetic war. It mentions a confluence of wild rumors, Trump supposedly threatening to invade Greenland, talks of military action in Cuba, severe unrest in Venezuela.
Right, a lot of noise.
All of these rumors caused a massive speculative surge, pushing gold to a staggering $5,500 an ounce. But then, what happened when actual kinetic war broke out with Iran? The exact event the gold community had been waiting for as the ultimate catalyst.
The price of gold dropped.
It dropped.
Because the onset of the war catalyzed the reality of higher inflation, which catalyzed the reality of higher interest rates, which killed the speculative appeal of the metal. The geopolitical premium evaporated upon contact with monetary policy.
If we extrapolate that out, it leads to a really dark scenario for the global financial system. If the geopolitical situation continues to fracture and the price of oil surges because the straits remain closed, what happens to those global central banks?
They get backed into a corner.
The source hints that they might be forced into a situation where they have to actively sell off their gold reserves just to acquire stronger U.S. dollars, purely so they can afford the surging price of oil on the global market.
If that scenario plays out, it creates immense, sustained downward pressure on gold prices at the exact moment retail investors expect it to be a safe haven.
It's totally backwards.
It completely inverts the traditional investing playbook and tracks anyone relying on outdated historical correlations.
Which perfectly transitions us to the final major theme of our deep dive, the Great Rotation. Because if the AI tech sector is a fragile bubble, teetering on a cliff of margin calls, and gold is handcuffed and potentially crushed by rising interest rates, where is the smart money actually moving right now? Where do you hide when the traditional safe havens are compromised?
According to the source analysis, the institutional money is actively rotating out of the speculative tech sector and flowing backward into the old guard of the economy, legacy energy and financial stocks.
Financials. The big banks. The sources note that banks like JP Morgan and Goldman Sachs actually beat their Q2 earnings expectations. I think a lot of listeners might find that confusing. How are the big banks thriving when the rest of the economy seems so stressed by these high interest rates?
It comes down to the core banking business model, which is based on a concept called the net interest margin.
Break down the nuts and bolts of the net interest margin for us.
Think of a bank as a financial middleman. The bank borrows money from you when you deposit your paycheck into a savings account. Historically, they pay you a very small amount of interest for the privilege of holding that deposit, maybe 0.1% or 0.5%.
Basically nothing.
Basically nothing.
Yeah.
Then they turn around and lend that exact same money out to someone else in the form of a 30-year mortgage, a corporate loan, or credit card debt, but they charge a much higher interest rate, say 7% or 18%.
Right.
The mathematical difference between the tiny rate they pay you and the massive rate they charge the borrower is the net interest margin. It is the engine of their profitability.
And when the Federal Reserve aggressively raises baseline interest rates to fight inflation, what happens to that margin?
The banks immediately raise the rates they charge for new mortgages and corporate loans, capturing that higher yield. but they are historically very, very slow to raise the rates they pay out on everyday savings accounts.
Oh, I see. So the gap widens.
Therefore, the gap between what they collect and what they pay out, the net interest margin, widens significantly.
So the banks essentially love a moderately high rate environment. Even if it crushes the average consumer trying to get a car loan, they're literally profiting off the spread created by the Fed's inflation fight.
Exactly the dynamic driving the rotation. Capital is flowing back into financial stocks because they are a direct mechanical beneficiary of the current macroeconomic stress.
The sources also discuss rotating into hard assets, real, tangible things. Copper, base metals for infrastructure, which intuitively makes a lot of sense, right? If we are genuinely going to build out millions of new AI data centers, we need copper for the wiring, we need steel for the racks, we need physical materials.
The logic is sound, but the sources point out a massive dilemma with this hard asset rotation.
What's the dilemma?
The problem is timing and valuation. If you want to rotate out of an overvalued tech stock and into a tangible asset like copper, you look at the price of copper and realize it is already sitting at near all-time historic highs. The trade is heavily congested.
Yeah, the source explicitly mentions this. Copper is at all-time highs, and oil is near all-time highs despite the engineered halts and SPR drains we discussed earlier.
So if you are an institutional investor looking for a safe harbor to park billions of dollars, you are essentially trapped. Tech feels like a bubble waiting to pop. Gold is suppressed by yields. And the commodities you logically want to buy are already historically expensive.
Let me try to visualize this. It's like trying to find a lifeboat on a sinking ship. But every single lifeboat, the commodities boat, the gold boat, the big tech boat, is already packed to the brim, and the people holding the tickets are demanding all-time high prices just to let you on board.
It's a perfect analogy.
Is there anywhere left to go that isn't completely overpriced?
The source mentions one potential, somewhat unglamorous safe harbor: the equal-weighted S&P index.
Explain the structural difference between the standard S&P 500 and the equal-weighted version, because it actually changes the physics of the index, doesn't it?
It changes everything. The standard S&P 500 index, which dictates the headlines every day, is market cap weighted. That means massive companies with multi-trillion-dollar valuations like Apple, Microsoft, and NVIDIA make up a huge, disproportionate percentage of the index's overall movement.
So if they move, the whole thing moves.
They act like a massive center of gravity. If just those few AI-adjacent tech giants crash, their gravitational pull drags the entire standard S&P 500 down with them, even if the other 490 companies are having a stellar quarter.
The index is just completely top-heavy with tech.
Correct. An equal-weighted S&P index, however, alters those physics entirely. It treats every single company exactly the same, rebalancing regularly so that each stock represents roughly 0.2% of the index.
So NVIDIA has the same weight as a paper company.
Exactly. The massive trillion-dollar tech company has the exact same mathematical influence on the index as the smallest regional bank or industrial manufacturer in the 500.
So, using my lifeboat analogy, if every other asset class is a desperately overcrowded luxury lifeboat, the equal-weighted S&P is basically the only middle seat left on the commercial plane that hasn't been drastically overpriced by the AI mania. It acts as a mechanical hedge against the extreme tech concentration.
It provides diversification away from the specific point of failure that the South Korean margin calls are warning us about. But we have to explore the long-term macroeconomic implications of this great rotation.
What do you mean?
Well, if capital aggressively drains out of the AI sector, out of the bleeding edge of technological development, and flows backward into legacy energy extractors and traditional banking, simply to chase safe yield.
What happens to innovation?
That is the ultimate casualty. How does that rotation starve technological innovation in the broader economy over the next decade?
Wow, I hadn't thought about that.
If the trillions of dollars required to build the future infrastructure are instead being parsed in 10-year treasury bonds and regional banks just to survive an inflationary supply shock, we might be sacrificing long-term economic evolution for short-term financial survival.
That is an incredibly heavy realization to end on, and it perfectly encapsulates the journey we've taken through this source material today. We started by looking at burning tankers at the Bab al-Mandab Strait. We traced the logic through engineered Chinese EV taxi policies, deep into the physical limitations and sludge of the underground salt caverns of the U.S. Strategic Petroleum Reserve.
Across a terrifying wave of 1 million algorithmic margin calls in South Korea.
And finally, into the vaults of central banks to reevaluate the myth of gold.
The text perfectly illustrates how deeply, inescapably interconnected the modern global economy truly is. A localized geopolitical conflict instantly becomes a global supply chain crisis, which forces a central bank mandate, which cascades into a retail investor's margin liquidation halfway across the world.
And to you, the listener, I think the most vital takeaway from unpacking these sources is a reminder of what it actually means to be well-informed. It isn't just about reading the terrifying geopolitical headlines or tracking the daily ticker of the NASDAQ in isolation.
No, it's bigger than that.
It is about learning to see the invisible strings of causality. It is recognizing that a centralized decision to halt oil imports in Beijing or a failure to reach a ceasefire in the Middle East is directly mathematically connected to the interest rate you're going to get on your savings account or the compounded price you will pay for a box of cereal at the grocery store next month. The world is a single, vibrating web of economics.
And right now, that web is under immense contradictory tension.
Which leaves us with a final, lingering question to mull over. A thought that builds on everything the sources presented today. We know from the data that the U.S. Strategic Petroleum Reserve is essentially tapped out to its physical extraction limit. We know global emergency reserves are at historic lows.
We have no safety net.
So if this temporary, delicate geopolitical balancing act fails, if the straits are permanently closed and we get a true, undeniable energy supply shock at the exact same moment that the over-leveraged AI tech bubble officially pops, how does a global economy survive a massive inflationary fire when it has already used up all of its financial and literal fire extinguishers? Something to think about next time you check your portfolio. Thanks for joining us on this deep dive. We'll see you next time.